Hello everyone, this is Devang Chawda working as Senior Manager in Products team of DSP Mutual Fund. I am going to take you through one of the exciting opportunity in the Indian IT segment uh, using DSP Nifty IT ETF. We are launching DSP Nifty IT ETF from 21st of June and the NFO is ending on 3rd July 2023. Why consider information technology sector? Rather, why consider Indian information technology sector? Now, IT is booming globally. So, when we see the growth in IT sector as compared to the GDP, we can see that the share of IT sector revenue as a percentage of GDP has been increasing. It means that the Indian technology sector has surpassed the growth of Indian GDP, and that's where the share of Indian IT sector has increased over the years from for the past 3 decades. When we see from a global context, we see that the growth rate of Indian IT exports as compared to the world IT spending growth is been higher, and since because of the higher growth rate, we see that the Indian IT companies are constantly gaining market share as compared to the global IT companies, which we can see from the right hand side graph. When we consider any company, what is the most important thing for a company? That is earnings. The more volatile the earnings are, the more earning surprises a stock can give, and which will ultimately reflect in the stock prices. When we see this graph on the left hand side, so this left hand side graph tells you about the earnings growth over last 10 years of various sectors in Indian equities. So the red line represent the Nifty IT Index. The other lines represent the other sectors in the Indian equities. So if we see the growth, earnings growth of Nifty IT has been very smooth as compared to all other sectors in the Indian equities. Even when we see the standard deviation of the earnings of Nifty IT, it is very lower as compared to other sectoral indices. Now, lesser earnings variability means that there are less chances of earning surprises, be it positive or negative, and ultimately, due to lesser earning surprises, the IT companies are typically rewarded with a higher multiples on a long over a long term period. Now, when we consider a diversified portfolio like Nifty 50, the most of the revenues of Nifty 50 companies come from India. So if we see the right hand side graph, almost 75% of the revenues of Nifty 50 companies are coming from India. It means that the companies of Nifty 50 has India specific uh, risk more and gets influenced by Indian geopolitical political situation more as compared to global phenomena. But when we see Nifty IT Index, which comprises of top 10 IT companies, almost 90% of the revenue is from other than India, and only 5% of the revenue is from India. Majority of the revenue is from US, and the next major contributor is from the European region. Now, since the revenues coming from uh, are coming from other than India, the IT as a sector is more influenced by global factors than Indian factor, and thus investing in Nifty IT can help you diversifying India specific risk and can take your portfolio uh, at a global level. Now, the recent rally in Nasdaq have made many people considering Nasdaq for investing. But when we see fundamentals of Nifty IT companies and Nasdaq 100, we see that we see that this Nifty IT companies are better place as compared to the Nasdaq 100 companies. So when we see on a fundamental factors like ROE and ROA, which is basically ROE represent return on equity, ROA represent return on asset. Nifty IT companies have a better return ratios as compared to the Nasdaq 100. In terms of valuations as well, if we see the Nifty IT Index, be it in terms of price to earning ratio or price to book ratio, they are relatively better valued as compared to the Nasdaq 100, which is nothing but a representation of global ITs. Thus, when we see from a fundamental perspective, Nifty IT or rather Indian IT companies are better placed as compared to the global IT companies. Now, let's look at valuation with respect to broader equity. Now, we have taken three valuation ratios, which is price to earning ratio, price to book ratio, and dividend yield ratio. Now, different valuation ratios are suggesting a different interpretation in terms of current valuation. So, when we see in terms of price to earning ratio, the price to earning ratio of Nifty IT index vis-a-vis Nifty 50 is still at a marginally higher level as compared to its long-term average. But when we see price to book ratio, the current valuations of Nifty IT relative to Nifty 50 is at the average level as compared to its long-term history. But when we see dividend yield ratio, the gap in dividend yield between Nifty IT and Nifty 50 has widened in favor of Nifty IT in the recent times. Thus, when we see valuations, the peak valuation which were there somewhere one and a half to 2 years back, that valuation has is behind us, and the IT sector has almost approached the average multiples, has approached the long-term average multiples. In the last 1 year, if we just plot down returns of various sectoral indices, Nifty IT index hasn't performed well, and it is among the worst performing sector in terms of returns. Also, if we see the last 2 years, Nifty IT hasn't given any returns as such, and it is still it is still more than 15% below its all-time high. What does this mean? It means that Nifty IT is already going through a value and time correction currently, and it may suggest a good time of entry. Now, if we see the Nifty IT index, historically, it has been noted that whenever there is a underperformance by this index, it is usually followed by outperformance. So, in this interesting graph, what we have done is that we have plotted the relative alpha, that is alpha between Nifty IT and Nifty 50. So, if we see the dark blue line, it is the historical 1 year alpha. If we see the dotted light blue line, it is the 1 year forward alpha. So, it means that whenever the IT index has been underperforming the broader index in the last 1 year, the next 1 year typically results into outperformance of Nifty IT as compared to Nifty 50. So if we see this period wherein Nifty 50, IT index has underperformed Nifty 50, the next 1 year IT had outperformed Nifty 50. Similarly, if we see this period, Nifty IT had underperformed Nifty 50, but the next 1 year period has been very good for the Nifty IT index. The same phenomena has been repeated in the past. So if we see if the same thing, let's say, happens to repeat in the next 1 year also, the Nifty IT index can outperform a broader Nifty 50 index, because if we see for the last 1.5 years, Nifty IT index has been underperforming Nifty 50 index. Now, weight of IT sector in broader equity, that is Nifty 50, has been around 15% based on historical data. But if we see the current data, if we see the current weightage of IT sector in Nifty 50, it's only 12.9%. It means that there is underrepresentation of IT sector in Nifty 50. And if assuming the weight to reach to the historical average number, IT stocks needs to outperform Nifty 50. So this again makes a case for Nifty IT index investing. Now, what is the composition of Nifty IT index? When we see the portfolio of Nifty IT index, it comprises of 10 stocks. The top five stocks constitute around 80% of the portfolio, and all and this index is predominantly large cap oriented. The weightage of each stock is determined based on free float market capitalization of that stock. This means that bigger the company is, bigger the weightage will be of that company. So if we see TCS is the highest weighted stock in the index, while the lowest weighted stock is L&T Services, which is around 2%. Some of the notable features of this index: the index consists of largely liquid and large IT stocks. Since the index takes into only takes 10 stocks which are weighted based on free float market capitalization, it means that only the top 10 large IT companies uh, will uh, will constitute as a part of the index. No stock will go more than 33% in the index. Maximum exposure to top three stocks will be less than 62%. The index will be rebalanced on a semi-annual basis. So, given the index construct, it is a concentrated index with maximum exposure to top three stocks. When we see long-term performance of Nifty IT Index versus the broader Nifty 50, the index has outperformed Nifty 50 by almost 1.3% long-term alpha. So even after correction in the last 1.5 years, still the alpha remains healthy for Nifty IT Index. In terms of rolling returns as well, if we see a 1 year, a 3 year, 5 year, and 10 year across all the durations, Nifty IT has outperformed Nifty 50 index. So let's come to investment team and process. So Anil Gelani and Dipesh Shah are the primary fund managers for DSP Nifty IT ETF. Achal Anmal supports Anil Gelani and Dipesh Shah in terms of execution of trades. So the investment team of DSP, so we have a dedicated investment team in DSP for managing passive funds, and this is in line with global best practices. Also, this is one of the kind in Indian mutual fund industry. Let's come to the risk of investing in DSP Nifty IT ETF. As the as we see the construct of the Nifty IT index, the index only has exposure to 10 stocks with with around 60% of exposure to only top three stocks. This means that the index is highly concentrated in terms of number of stocks as well as in terms of sector. Due to high concentration in the index can be subject to high volatility and high drawdown as compared to diversified equity funds, which can result in underperformance of this index in with respect to diversified equity funds in shorter term period. To demonstrate the risk, we have plotted down returns of Nifty IT index as well as Nifty 50. If we see, there are times when Nifty IT index has underperformed severely as compared to Nifty 50. So if we see the cells highlighted in red, This represents the severe underperformance by Nifty IT Index. Thus, this index can witness a significant underperformance on a shorter term period, which an investor needs to keep in mind before investing.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.